And then on Tuesday, MBS were up 5 basis points in the morning. Stocks were up small. It was a fairly straightforward overnight session with bonds holding perfectly flat in Asia, and then following European yields steadily higher. EU bonds took a hit from the higher than expected producer prices, while elevated supply made for an unsupportive backdrop. In domestic sessions, markets saw some improvement to the JOLTS numbers. JOLTS came in at 9.931 million versus 10.43 million forecast. It was 10.824 million last time. This big drop in job openings and a sign that the labor market may finally be softening. We also got factory goods orders. They fell 0.7% on an estimate of being down 0.5%. ISM manufacturing index fell from 47.7 to 46.3 in March. Estimates of 47.5, not including COVID. We have to go back to 2009 to see a figure this soft. However, keep in mind that this bad news is good news for the bond market, because we need bad news to have good news in the bond market. Home prices rose marginally in February, according to Black Knight. This was the first increase in 8 months. Black Knight attributes this to a decline in rates at the beginning of February, bringing some buyers back into the market. That said, inventory remains extremely tight and isn't improving. Some of the usual suspects, places like Miami, saw price increases. Overall, prices rose 0.16% month over month, rose 1.94% year over year. CoreLogic's version of the report showed a 0.8% month over month increase and a 4.4% year over year for February. However, we're not even going to look at CoreLogic's predictions because they suck so bad at them. You would think that with such low inventory, the home builders would be stepping in to the breach, but with their cancellation rates being pretty elevated in the fourth quarter numbers, many are still slowing off and they're burning through their backlog. Private residential construction fell 0.6% month over month, down 5.7% year over year in February. Single family construction was down big, 1.8% month over month, 21.4% year over year. On the other hand, multifamily was up big, 1.4% month over month and 22% year over year. The Reserve Bank of Australia also joined the Bank of Canada in holding rates steady. Mortgage rates are still high on the idea that the Fed will have to cut rates in 2023. I'm personally not buying that, but that sentiment is slipping away like sands through the hourglass. Friday's jobs data could give bonds a bit of a boost and therefore pricing a bit of a boost, but I don't trust it. I don't think that's going to happen. Anyway, at the end of the day, we're up 20 basis points, which puts us at 101.34, which puts us in the upward bounds of that range with the flat red line, which is 101.672, a Fibonacci retracement, and the 200-day moving average at 101.087. Had 6 winners in a row. Jeez, hard to look back and find 6 winners in a row anytime. You got to go back, it looks like January for that. So keep that in mind tomorrow. Starting May 1st, OPEC will reduce oil production by 1.1 million barrels per day. What is most interesting is that OPEC already cut production by 2 million barrels a day back in October, yet prices kept falling. The question is, with the cut, will demand finally exceed supply? If so, prices rise, inflation will get worse, and the Fed's job will be made more difficult, and recession odds will somewhat increase. Our March gross issuance of all agency mortgage-backed securities rose from a minuscule 58.1 to a merely paltry 69 billion, an 18.7% rise from what was the lowest monthly tally seen since March of 2014. But if you want to learn new stuff to help you with your life, check out our sponsor at WellThatMakesSense.com. This is from Peter Diamandis' 31 Laws. You get numbers 20 through 25, which include you get what you incentivize. Everything's all about incentives. And if you think it's impossible, it is. For you, not everybody else.